Thank you for joining our webinar today entitled Farmland, Fertile Ground for Investors. I will be joined by my colleague Brett Rentmeester and Perry Veith of Ceres Partners to discuss the investment opportunity presented by Farmland today. First, I'd like to note that while we are talking about investment themes, we're not providing specific investment advice. My colleague Brett is President and Chief Investment Officer of WindRock Wealth Management. WindRock is an independent investment management firm serving a select group of high net worth individuals, family offices, foundations, and retirement plans. Brett will begin by discussing the supply and demand dynamics for agricultural products and later the impact of macroeconomic influences on farmland values.
To tell the proper story, when we piece together supply and demand, we think there's been a strong tailwind to farmland. If the U.S. has around 300 million people, for every billion people, that's about 3 USAs being created out of thin air. So over the last really 60 or so years, we've seen the equivalent of 13.5 USAs created. Those are more mouths to feed, more demand for food in farmland. As we look forward into time, most projections suggest that we're going to add another 2 to 3 billion people over the next 35 to 40 years. So what we're talking there is another 6 to 9 USAs. Again, more mouths to feed. And the other thing you see on this chart is that most of these mouths to feed are in the emerging economies. And we'll talk about the implications of that in a couple moments. So when we look at the emerging markets, we're going to use China just as a guide because they've been such a big consumer of everything. But it's clear that these large countries have huge demand. And look at, for example, in this chart, China's share of different commodities. They consume half of the world's pigs and almost a third of the world's eggs and rice, just tremendous quantities. And like most emerging economies, China faces two major dilemmas as it relates to food and farmland. One is the availability of good arable farmland, and the second is water, good fresh water sources. And I want to talk about those two next. Starting with arable land, China's population of about 1.35 billion is approximately 4.3 times that of the U.S. But on a per capita basis, per person, they only have 15% of the arable land. So think of it this way. The average individual in the U.S. has about 1.25 acres of land to support themselves on, whereas in China it's only 0.2 acres. So there's not enough land to support the average Chinese consumption pattern. So therefore, China and most of these emerging economies are going to be forced to continue to look to the U.S. and other areas where farmland is more plentiful. If we zoom out of the comparison between China and the U.S. and we just look at arable farmland going back in time on a global basis, we look back and we see that per person there was a fair amount of supply back in 1960. One way you can think about this chart on an individual basis is pretend you were gardening. And back in 1960, this would suggest that every individual in the world had about 1.25 acres to grow a garden on. So could you support yourself for a year on a little over 1 acre of land? And it's hard to imagine, but you probably could if you had to. Now fast forward to the year 2000. By the year 2000, that had shrunk to less than 3/4 of an acre. So now do that same math. Can you feed yourself on 3/4 of an acre? Now by 2030, that goes to under 1/2 an acre. And so I think what we're seeing is the combination of population growth combined with relatively limited supply of good farmland is going to continue to make this dynamic a difficult one and therefore be very supportive of farmland. 2030 seems like a long way off, but it's really only 17 years away. So these are the types of things we're looking at. The other side to the equation, though, Chris, is fresh water availability. This has been a topic that's been discussed more recently. This is a map basically showing freshwater availability with the yellow and orange areas of the map showing dry regions. And what you find is that the dry regions generally are coinciding with the emerging markets where most of the demand is going to come from. So look at China, look at India. These are dry areas with not real plentiful sources of fresh water. And so they're forced with a trade-off on how they use their water between, do we use the water for, our individuals and businesses, or do we use it to grow crops? And increasingly, we think the emerging economies are going to choose to import crops and save their water for other precious needs. This has also come up recently with many intelligence agencies. The U.S. National Intelligence came out recently with a report this year predicting that water demand will outstrip supply by 40% by the year 2040. So you've even got intelligence agencies now looking at the water scarcity issue and taking it for real. So we think this is a pattern that will persist, but will be very supportive of good farmland in regions that have water. Second element to this is changing tastes. As the world grows and people become wealthier in these emerging economies and more of a burgeoning middle class, people tend to prefer meat over grains. We've seen this documented in countries like South Korea. We see it in China and other regions that as you get a wealthier middle class, their tastes change. So what does that mean for water? Well, let's talk about grains first. To produce 1 ton of grain, it's estimated to take 1,000 tons of water, so pretty water intensive. But to produce 1 ton of beef, you not only need that ton of grain, you also need 15,000 tons of water. So meat is even more water intensive. And if we kind of look ahead to see what's happened in countries like China, this is their meat consumption relative to the U.S., you see this dynamic playing out, where changing tastes are putting more of a strain on the food supply and the fresh water supply around the world. So I guess the question that comes up is, well, what about innovation and technology? Do we have the tools to solve these dilemmas with what we've got today? And this chart here shows the 10-year average annual growth in crop yield. So how productive is the land? The blue line illustrates this. So back in 1971, you were getting about a 3.5% annual crop yield growth. So through the combination of better technology, fertilizer usage, you were getting an increase in what the land would produce. Recently, that's diminished all the way to about 1.5%, and that's despite the fact that we have better technology, despite the fact that we're throwing more fertilizer, at the problem. So we're not ruling out innovations, but we're just suggesting that there's less bang for the buck, for fertilizer applications and other things as we look forward. So we think innovation and technology will help, but it's not the golden solution that makes it all work. So I guess just to recap the sector trends on why agriculture has done well over the years and why we think the backdrop globally is there in the future. It's the demand side of increasing populations, again, rising from about 7 billion people on the planet today to 9 or 10 billion by the year 2050. It's a changing consumption pattern and demand in the emerging economies. So again, as people get wealthier, tastes migrate to meat. And on the supply side, it's the combination of the limited arable land and less acres per person in the world and water scarcity and that accelerating effect.
Great. Well, let me introduce Perry Veith. Perry is the President and Chief Investment Officer of Ceres Partners. Ceres Partners operates a fund which acquires undervalued farmland, which is then leased to local farmers who grow corn, soybeans, wheat, or specialty crops on a scheduled rotation. Ceres Partners currently owns over 40,000 acres of farmland located in Indiana, Michigan, Illinois, Kentucky, Georgia, and Ohio. So Perry, like most things, the devil is really in the details. So while someone may like the opportunity presented by farmland, the question becomes how you go about acquiring farms, which is obviously something Ceres specializes in. I know you've brought some case studies to demonstrate the buying process, so please feel free to cover these.
Sure. Thanks, Chris. And first, I just wanted to emphasize how much I agree with everything that Brett was just talking about. Those are the same themes that we've seen, in the last 6 years that we've been operating Ceres. And to emphasize even more that as Brett was talking about including more meat in their diet, the way we look at that is it takes, as he pointed out on one slide, almost half of the world's pork is consumed in China. It takes 4.5 pounds of grain to make 1 pound of that pork, and beef is 7 to 1. So it all starts with that grain. That's what is the source, the food source at the bottom, and the United States is the most efficient agricultural producer in the world. So it is our strength. We have the infrastructure. We have the water, as Brett mentioned. We have the technology, and all these things allows for us to be the top producer. So, but you're right. You know, how do you go about finding those farms and the farmers and make it so that it's an attractive investment for investors? So we've got a slide here that shows how we've done that at Ceres, and what this demonstrates. This is our farm referred to as the Overmeyer farm. And you can see these also where they're located on our website, but this is in north central Indiana. And what it shows is how we're willing to aggregate our properties and then add to it over time. We have some very large farms. Our largest farm is close to 7,000 acres, but we're willing to buy smaller farms and then add to it. So this farm started with what is that purple rectangle box that back in December of 2008, and that was at that time it was the Redland Farm. It was 90 acres, irrigated farm, attractive. But then in time in December 2010, the large red box became available. This was a institutional seller who had to sell by year end for tax purposes and wanted to sell to a single buyer and wanted a cash sale. So it played well into our hands for our investors. So that was about close to 1,500 acres that we added at that time, and for just short of $4,300 an acre. We then, let me pause. Well, I'll finish out the acquisition, then I'll come to the other economics of it. But we then, the yellow boxes, we added 5 other farms in this area. We actually, a couple of them reached out to a landowner that we had bought from before. It was an estate that was looking to unwind some of their holdings, and so when all said and done, we have about 2,000 acres in this one location, and we actually averaged down our cost of acquisition so that we're only a little over $4,100 an acre. But on the next slide, we show some of the other points and how we continue to add value for our investors. So the important thing, so there's the acquisitions, but then we refer to them as our tenant partners. They're very important to us for multiple reasons, including sourcing new land to us. They will sometimes bring it to our attention, or also making improvements on the land, and then of course paying us a strong rent that delivers current income to investors. In this case, we had 2 of our, so we have these tenants. We work with over 33 different farm families currently, and we're always looking to expand that. But in this area, we had 2 of our farmers who overlapped into this area. So when we bought the large red component, red outlined area, we immediately put 2 of our tenants on there, and they each paid double of the rent of what had been the previous owner had been getting. So whereas before that the rent had been $175 an acre, we in that first year, without even us making additional improvements, doubled that to $350. So we got a strong rent, above a 6.5% return just on the income component.
Perry, related to that, how do you structure the leases when you have a new tenant? Both term and other conditions.
Sure. So we tend to do staggered 3-year leases. The tenants like to know that they're going to be on there for a period of time so they can make improvements. And also when some of the fertilizers are such as potash and lime, they deplete over multiple years. So our tenants prefer it. We can get a higher rent by having that 3-year lease. What we do when we structure that is we will add a flex component to it, so that if in the later years, year 2 and year 3, price of corn goes up, we participate in that additional yield or income that the farmers get. So we have those. So they tend to be 3-year leases. There's some that are 5, but we stagger them so that in any given year we have between 25% to a third that roll off and that we then reset at market price.
And related to that, you had mentioned this network or the families of farmers that you work with, I assume both to find new properties but also to find tenants. As it relates to the tenants, what kind of due diligence do you perform?
Sure, and actually, so something that we do which is different is we source our tenants before we source the farms. Like any good business, the people you work with are critical, and so we're constantly looking to expand that base. Sometimes we meet them at an auction. When people see that we're a successful buyer, they will approach us. We'll start the conversation at that time. We go into an auction or any purchase we make knowing in advance who our tenant is going to be. Also, we get referrals from some of our existing tenants who know farmers in other areas, and they suggest that they might want to work, should consider working with Ceres. So we start the conversation with them. We will go out and visit with them. There's one farmer that it took 1.5 years that we went through this process. I met with him in January, met his entire family. Then as he started planting, even though it wasn't our fields, we went out to see his team in operation, look at their crops during the season, because we want to team up with the best producers using the best technology, and we want them to be financially strong. We will speak to their bankers, and so it's a entire process that we look into finding that farmer first, so that then when if land comes available, and they all will travel different areas. So as I mentioned, people they would love to have a large contiguous farm, but the makeup of the Midwest is that you have a lot of these other smaller farms that made up when farms consisted of 80 to 120 acres that a single farmer would do by himself. So if a farm comes available in an area, we will then look to speak with a tenant that covers that area, and it might be that it's 20 miles from his home, or some will travel as far as 50, 60 miles. They'll develop a pattern so that they get to each of their properties. I think on this next slide, to kind of illustrate that, this is an example of one of our tenants. The red star is where they are, where their home base is, and then these yellow thumbtacks are different farms that we've acquired in the last couple of years for them, and so they will develop a pattern to go around and hit each of these. So this is a relationship that we started recruiting them in 2011. We bought our first farm for them in 2012. And then now since then we've added another 10 farms, so we have close to 1,300 acres for them. And this also kind of shows you how we aggregate them. So you notice that cluster of yellow pins in the kind of a lower right-hand corner. That started with just one farm that was available. It was an area where it was a little bit sleepy as far as price recognition by the neighbors, and so a couple other farms became available, and now we have close to 600 acres right in that little close proximity. So it's something that that we like, and the tenants are very pleased with. But if you think about this, so these are just the farms that this farmer has for us. They have other farms in the area. They also rent from other landlords, and they like having, if those become available for sale, they will bring that to our attention, so they want to grow. All the tenants want more acres, but they also don't want to lose acres that they have. The average age of their landlords tends to be in the low 80s, and so they're concerned. They know that as these people get older and they sell, that if they themselves don't have enough capital to get it, and another farmer buys it, they're going to lose those acres. So they like working with someone like Ceres, who can then not only acquire more acres but also maintain the acres that they're working currently.
This is kind of the geographic radius that you see as the maximum for one particular tenant to be farming properties.
So I'd say, well, it depends as they grow, and to give you, put it in perspective, a single person, a single employee can farm about 1,000 acres. So what the typical farm operation that you see is you might have 3 brothers working together, so you're supporting 3 families there, and then they might have 2 people working with them, so you've got a total of 5 people. So to be cost effective and to spread out their fixed costs over large enough acreage, they need to be farming between 4,500 to 5,000 acres, and and that the equipment in farming, a combine costs $400,000. You want to spread out those fixed costs over more acres, so that's why they want to grow, and that's how they do it. So if you have that group, if you have those 5 people, they can farm within a 30 to 40 mile area. But you can also take probably our largest farm group that we work with. They operate out of Michigan. He actually has 4 of these different teams within his group. So that's a case where that farmer farms over 30,000 acres himself. He has several of these different operation teams, and so they can each cover a 50-mile radius area. I do think that it kind of gets to where's the future going with farming. I mean, they are growing a commodity. It's going to go to the low-cost, efficient producer. I think you will continue to see consolidation into larger acres within these groups of farms. And the best tenants recognize that. That's why they want to grow. Why they want to be with Ceres is not just to rent a single particular farm, but they want to grow. If they're at 5,000 acres now, they know that they need to get to 10,000 acres 5 years from now, and they just don't have the capital to do that. Their capital is better deployed in their operating lines and in their equipment. They themselves can generate a higher return on their equity by working with someone like Ceres to invest in the land. And we're not viewed as, we're not in competition, because they're an important part to our strategy, and so it's really a symbiotic relationship. They are our tenant partner, and we are their land owner partner. So I think just to finish this next slide here also gives you a little more background on what does a typical farm look like. This group has about 7,000 acres that they're farming in this radius. It consists of 5 college-educated. In fact, one went to Cornell Ag program. They are using the latest technology, all the GPS controlled tractors, and they also engage, in addition to corn, soybean, specialty crops and vegetables. I think this next chart here shows you the most recent drought update, and it kind of gets to the point that Brett made also about water and how important water is. We think water is very important, and that's why most of our land is in the eastern part of the Corn Belt. We will continue to expand out, but we're always going to, we want to keep that water in mind, and so it's very unlikely that we're going to go to the far western part of the Midwest or into the West Texas Panhandle. There's ground that's dependent on irrigation, and they have aquifers that they're depleting. So long term, it's not a sustainable operation. We like irrigation. We're very strong proponents of that. But the irrigation that we're doing in the states, Indiana, Michigan, Illinois, is supplemental irrigation. So if Mother Nature provides enough rain, it's not turned on. But cases like 2012, when you had the drought, which covered even a larger area, our tenants were able to produce a good crop because we had the irrigation. And so especially in northern Indiana, Michigan, there's a natural recharging aquifer that's being supplied from the Great Lakes, and it makes it a great area for growing. To put it in perspective, water is ideally, corn would like to have an inch of rain a week, and so if you think about it, if it's a 12-week growing cycle, that crop is going to need about about 12 inches of rain. And so when we export, and Brett has shown a slide about China and the water that it takes to produce a crop, I like to tell people that we're exporting water. It's just that when we export corn or soybeans, it's in a form of that's much more transportable. But that's really what those grains are that we're producing as a form of water. So the drought conditions will vary over time. But if you're buying your land in an area which has abundant and natural water to begin with, your risks are much lower. And
so is water being factored into the price of these properties, or is it, how much of a premium is there, if at all?
Right now, there really isn't that much. I mean, that's something that we want to take advantage of. We love finding land that doesn't have irrigation currently, but is in one of these areas where we can put a well in and we can add irrigation. It's a way that we increase the value. So beyond the cost of that well or the irrigation equipment, now that the land goes up in value much more because it is an existing irrigated farm, and so that's right now. We report. So before you drill the well, you will report it to the state and you report your usage, but it's really a underpriced component of the farmland at this point in time. In fact, I tell people it's really not so much. If you look at 15 years ago, if people said where's the best place to farm, people might have pointed to Western Illinois or into Iowa. But now, and yes, and people were just thinking about soil, and yes, those areas have very good soil. But what we learned last year with the drought is that you can have the best soil in the world, but if you don't have a good water source, you're not going to get a crop. And then the other thing is you also need to have drainage. So this spring we had too much water, and so some of those heavier soils that don't drain well doesn't allow the farmers to get on and make a crop. So we look for both those things: the water and also the drainage that it's offered. The other thing is when building an ag portfolio, you might want to look at what types of crops, what farms are growing. The two general areas you can look at is row crops, things like we've been talking about so far: corn, soybeans, wheat. Those are annual crops that are planted each year. The alternative to that is you also can look at permanent crops. So permanent crops would be things like almond orchards, pistachios, vineyards. And as you build out your portfolio, you might want to add more of that. But we focused on the row crops, and for a couple reasons. One, the row crop is putting more emphasis on the earlier themes that we talked about as far as food and feeding the emerging economies, things like that. It's those grains that they want. So if you really want to capture the growth in the population and the diets wanting more meat and things like that, it's the row crops that are really going to do that. Also, another reason with the row crops, you're making more of an investment in the land itself. As an example, in a vineyard, you may pay $100,000 an acre for some of the land in Napa Valley. What you're really paying for there is the vine, or if it's an orchard, it's the tree. And so more of your investment is actually in that component as opposed to the land. And so we think from as we look at inflation protection assets, things like that, the more the land play is what you want. And then also when you look at the returns for the two different types of crops over time, the row crops are actually a more consistent return profile. What can happen is, like on this chart, the spike you see, permanent crops did have a good return in 05, 06. That was when really that's primarily related to almonds, and that was a major increase in demand for almonds during that time period. But if you're in the wrong crop, you don't have almonds. Let's say you've got walnuts. Well, then you shouldn't participate in that growth. So the grains, the row crops, are more uniform in their response from a return perspective. Maybe one other thing that we have to, one question I get is people ask, well, what's the impact of the biofuels? And so far we've been talking about food, and that's impact. We think from a secular standpoint, it's going to be the need for food that's going to drive the price of grains higher. If oil goes high enough or if price of grain comes down low enough, it becomes even more economic to use the biofuels. We've ramped up. There are no subsidies, or no longer any subsidies for ethanol in the United States. There is the mandate that we use a certain number of gallons per year, but we've ramped up to that. That's leveled off, it really, from here going forward, will be a trade-off between the profitability of the ethanol producers. One thing that you'll hear different things about whether people, depending on whether they support it or not, but an important use of ethanol that's produced as a substitute for MTBE in an additive in our fuel. So MTBE was a terrible pollutant. It was getting into the groundwater. There were some famous California cases, and so ethanol was used as a replacement for that. So I think that's kind of a good introduction on what we did. I think I would emphasize that it's important to have the right farmer, find the right ground. You don't want to overpay, and you want a good farm manager. It's not just like buying, making an investment in stocks that you bank on a computer screen. Our team spends a lot of time in the field with our tenants and finding land that you want to invest and make that, own it for a long time. It's a long-term investment.
Well, great. Well, everything we've discussed so far relates to either the opportunity with farmland based upon supply and demand dynamics, as well as the investment considerations that are pivotal to buying and operating farmland. But Brett, I know you also like farmland based on your outlook for the economy. So how does your view on the economy in general affect farmland?
Yeah, that's right, Chris. And let me say, when you're making an investment decision, we think there's two major components. There's the bottom-up, looking at each specific opportunity and is it attractive, but there's also the top-down view of what's the state of the world, and is the state of the world supportive of this particular investment theme. So unfortunately, the news I have to share is that the state of the world is worse than advertised, but it's supportive of things like farmland. And let me explain. What's advertised is that we have a lot of debt in the developed world, the U.S., Western Europe, and Japan, but that debt levels are roughly equal to GDP. So in this chart, what we hear in the U.S. is that debt levels are approaching $17 trillion, which is a little bit more than our GDP or our gross domestic product, what we produce as a country every year. However, that excludes a big chunk of liabilities that the government calculates but doesn't report in the official numbers. The low end of those estimates are, approaching $70 trillion. So these are today's liability to put money away for things like healthcare costs, Social Security, unfunded pensions. So when we do true accounting like a business would have to do, Chris, we come up with a total that says our debt here in the U.S. is probably closer to $87 trillion. And $87 trillion is over 5 times last year's GDP, so really a staggering amount. And again, it's not just the U.S. This is true in Western Europe. It's true in Japan. So how did we get here? Well, it's been a long-running story, and it's a story of overspending and debt-fueled consumption over the last 40 years. So when we look back in the last 40 years, we go back to 1971. Prior to 1971, the U.S. dollar was backed by gold. And the backing with some level of gold meant that in order to print money out of thin air, you needed more gold to support the value. All that changed in 1971 under President Nixon. We removed the backing of gold. And since that point in time, we've had somewhat of an open checkbook, to support our overspending. So we show two things on this chart. We show a green line, that's the increase in the money supply or the monetary base, so the printing of money. And we show the red line of an increase of inflation. And so you can see the scale goes back to a level of 25. We've had tremendous increases since that separation from the gold anchor in 1971. And we have this dark line in 2008 during the crisis. And what's really jumps off the page, I think, to all of us, is that since that point in time, the money supply illustrated here has roughly tripled. So we've printed an incredible amount of money. Now, the reality is inflation doesn't always move step by step with money supply growth, but they have a very close relationship. So there's often a lag effect. So what our worry is we've created the conditions for a lot of inflation ahead. And the reason being is there's too much money in the system. And I like this analogy by Milton Friedman where it's his fool in the shower analogy where he says a fool jumps into a cold shower and because it's cold he turns the handle all the way to hot and doesn't get any hot water until it's actually scalding water. And I think we're kind of playing into that same analogy today. We've taken the money supply handle and we've pulled it all the way to hot, and we've had this huge spike up in money in the system, and yet we haven't seen the corresponding scalding water, but we think it's coming. And it's a very dangerous predicament because we're at a juncture where all of the investment assets that Perry was alluding to, the financial assets, the paper assets like stocks and bonds, are now reliant on continued government spending. We just saw with some recent news of maybe the Fed tapering their purchases at some point that markets have gotten really volatile. So you get yourself in a box where if you don't print more, markets might go down. However, as you print more money, the inflation risk rises. So, that puts investors in a real dilemma because even though it's not evident to most today, we think the biggest risk ahead is inflation. And yet, interest rates today don't reflect that. So normally, in inflationary periods, interest rates are higher and compensate investors for that risk. But we have the opposite today. We've got a prognosis of dangerous inflation off on the horizon, but today we're at record low interest rates. And this is just a chart of interest rates here in the U.S., which are at all-time lows. Europe has records that go back 500 years. We're at 500-year low in interest rates. So what this means for the average investor that's concerned about the state of the world, as they rightfully should be, is the idea of parking your money in cash or bonds as your safe haven just doesn't work anymore. And the reason it doesn't work is, you go back to 07. Back in 07, someone with $10 million could have put that in short-term treasury bonds, almost a cash vehicle, and earned about 5% or $500,000 a year. That same investor today is getting almost no return and about $14,000 a year. So where do you go with conservative money? We think increasingly investors are going to look towards what we deem to be more conservative hard assets, things like farmland, rental real estate, some things that tend to be relatively recession-proof. And so, I guess to sum it up, the dilemma for investors today are where can you find reasonable returns in a world of compressed interest rates where everything's priced off of low rates? And how do you protect yourself from this inflationary surge that's a very real possibility as we look down the road? To answer that question, we can look back in time and we can ask, well, how have things like farmland done during other periods of inflation? So when we go back to the late 60s, this country had social programs being implemented. We were fighting the Vietnam War. It fueled the way for very high inflation through the 70s. In the 70s, most people recall as a stagflationary environment. That is to say, a stagnant economy, so choppy growth, but inflationary conditions. And we think we're setting the stage for the same type of backdrop. So what happened in the late 60s and 70s? Well, prices more than doubled in the green line, and farmland in blue went up over 400%. So we think farmland and certain other hard assets are, essential goods that respond well to inflation. So if we can find investments that we think today are stores of value that do well in a choppy sideways world, but are also positioned to have that extra benefit if we get inflation, those are the things that we think investors will increasingly look at.
So it appears that farmland obviously has quite a bit of potential from an appreciation standpoint. I was curious, though, you had mentioned about the low interest rates and where do you find yield in today's environment. Perry, what kind of distribution yield do you have on your fund, and how is that? Obviously, it's structured probably fairly closely to the leases, but can you just explain that a little bit?
Sure. And actually, a lot of people of our investors are looking to us as a substitute for their fixed income portfolio. So, if you can think outside the box a little bit, in a portfolio, I think it's good to reduce that fixed income allocation and get the income that we deliver. So, we target a 6.5% cash-on-cash yield when we are setting our leases and when we are making our purchases as well. So, an investor can look for each year we're going to generate that approximate 6.5% income component. The portfolio right now in overall yields about 6.2%, because some of those, if we're in year 3 of a lease that was set 3 years ago, even though it was 6.5% 3 years ago, it might be a little bit lower as it comes into the portfolio. So, so the income component is going to be 6.5%, and then to go with that, just to finish on the return expectation, you have the appreciation of the land, similar to what Brett had just shown on that previous chart. I like to cite the Chicago Federal Reserve Bank has data going back 45 years, and the average annual increase is about 6.5%. So those two elements, the income return of 6.5 and the land appreciation is 6.5% as well. The third element of return that we then looked at is in trying to find on the buy side, finding that undervalued property or finding that property that you can improve, and either whether through increasing the amount of tillable acres or adding irrigation. So those are the three main components. So it's the income, the long-term appreciation, and then the improvements to the farms that can be made.
Great. Well, you mentioned the kind of the bargain, or the intent at least, to have a bargain purchase price in the properties that you're looking at. Is there any particular metric that you use or that you shoot for as far as a discount relative to what would be called the fair market value, I guess?
Well, the main thing that we look for is like I said, our buy decision is that cash return, the yield on that 6.5%. We like to see additional appreciation that can come through improvements, but there's no hard number as far as a discount that we expect.
And I know you're always looking at efficiencies and other areas to add revenue. Do you ever look at or do you factor it in, or is it just considered kind of gravy on the investment, some other revenue enhancements, whether it's potentially the fracking from maybe some Ohio properties, or if it's the potential for windmills in various areas? Is that a consideration, or is it just something that can develop and obviously add some incremental revenue?
No, absolutely. So what we refer to those as free options. So we love finding farms where we can get some of those free options. The buy decision we won't pay anything for it. We won't pay up. It will cash flow as a farm, but if it's whether it be probably 95% of our acres we have the mineral rights, and it may be either something immediate or maybe long term that comes into play. As an example, just this morning I was looking at one of our farms that we bought within the last 3 months. They want to start producing oil on it. What we're looking at is probably that farm will pay for itself in 2 years' time once they get into production, and so our investors will get a nice return from that, from the oil that's produced from it. This is southern Indiana, so there's the shale and the gas is much more is prevalent in a lot of these areas. Michigan is another one. We've got quite a few properties in Michigan. There's a shale region under Michigan, and they're just now exploring whether that can be produced economically as well. So mineral rights. We also have the wind rights. If people want to put up windmills, we have a couple of our farms that fit into that, and then water. as we mentioned, 10 years from now, it might be that the water is something that is one of those ancillary revenues as well.
I was curious, when you're in the marketplace acquiring these properties, who else is bidding on them? Is it other investors? Is it just farmers?
So most of the time, the competition comes from other farmers, and even though there's been more talk from investors and institutions are looking at it, we rarely are running into investors, which is a good thing. I frequently tell people that the day that I go to one of these small auctions in one of these little towns and I see somebody from one of the Wall Street firms there, then I'll know that it's time to sell the portfolio. But we don't. It's primarily the neighboring farmers, and they will oftentimes pay a price higher than what we're willing to pay. So we're disciplined as far as what properties we select from. The other thing I should point out too is when the farmers are buying, they tend to be cash buyers. So there isn't much debt in the system, which is a positive, and it's we'll continue to support land prices here. The other thing I like, one positive that I like about having these other farmers that we are competing against is, if and when we want liquidity, it's a ready source for us to sell into it as well.
I was going to say, Chris, maybe just let me add on Perry's comment, because we talked earlier about the risk to the financial markets today with so much money printing and intervention, and with even talk of tapering that back, sending bond markets and stock markets down. We like farmland. We like things that are disconnected from that pressure. Obviously, the Fed is buying bonds directly. They're handing money to banks who are handing it to the proprietary trading desk to trade equity markets. But the farmland market, as we see it, is still a very fragmented mom-and-pop industry, much as Perry described, without the signs that cheap credit and massive groups of investors have bid it up. So we do hear investors interested in the space, but most haven't purchased farmland. Most are still trying to find a vehicle that makes sense, and so we think that's a benefit to considering farmland.
And Perry, I think you may have alluded to this previously when you were talking about the efficiency of American farms, but are there any other reasons? Is that the main reason that you're looking at the United States, or an investor should, versus other countries that may be cheaper, like Brazil, et cetera?
Well, there again, I like to look at it from a portfolio perspective, and so I tell people, as you build out your portfolio, you might want to add, different crops into your portfolio, or international exposure. But I think where you should start with is start in the U.S. It's kind of like building a fixed income portfolio. Treasuries, you'll have treasuries being a component, and then you might also add in some corporate bonds and high yield. But as you add in those other higher risk assets, they should deliver a return that exceeds that. So I like to point to our track record with prime Midwest farmland and say, okay, well, then you should be getting that return plus something if you're going to go to these other areas. So from a portfolio standpoint, I think starting out with a core portfolio in the United States is very important. The other thing is that in looking at these other areas is there are other ancillary things to consider. As I mentioned, that the 110 that we talked about, he's farmed down in Brazil. They're moving out, and the two things that I hear from several of our people I speak to is that we underestimate in the United States our infrastructure and the importance of the rule of law that we have. In those other areas, you don't have a good deed system. There might be 100 people that have some claim to the deed, and that infrastructure just adds to the cost. So just recently here, they talked about how the Mato Grosso area of Brazil, it's the price with corn at $5.50 a bushel. It's not economical for them because they have to truck their product once they grow the corn 1,200 kilometers to get it to a market. And so there's the time and the expense that it has to be added to it. So even though the land might look cheaper, our U.S. land is more productive, producing a higher crop, and is lower cost for that production.
So let's do one final question, and we can start with Perry. But If you have one takeaway for today's listener, what is it?
Well, you know, my takeaway is the same thing that I did with myself. I am personally invested in Ceres and in Farmland very heavily. I think I made that decision because I wanted to hold more hard assets in my own personal portfolio. I think it's important for people to add hard assets into their portfolio. I think in general people are underweighted to do that. And then I think ag is an important part of that. And it offers that nice high current income as well as long-term appreciation and inflation protection. So my message would be is you know, add to your hard asset position and consider ag as an important piece of that. And Brett?
Yeah, Chris, I think it's, you know, back to the big picture macroeconomic view, which is we're in an unsustainable position of too much debt and too much money printing. And the implications of that, you know, low interest rate world are it's very hard to find return. So where can you find reasonable return in a relatively conservative wrapper that also protects you for inflationary forces ahead? And I think there are very few things that meet all of those different tests, but I think farmland is one that if you could buy something, close your eyes, and open them in 10 years, that would be one of the investments you'd want to own.
Well, great. Well, gentlemen, thank you very much for your time today. If anyone has any questions, please feel free to contact us with the contact information listed on the screen. Thank you.
Thanks, Chris. Thank you.